We anticipate the next peak will be in the gold price based on the last gold price peak was back in 2002, almost 25 years ago. Look at the gold market that we're in now, and it is in a secular bull, and I've been bullish on it almost since day one. I think peak in this secular bull will probably come in around 6,000.
Most of the silver which is actually mined is mined in conjunction with something else like copper or gold, and therefore it's not so much the rising price of silver which caused people to mine more. It would be more a rising price of gold or rising price of copper would perhaps boost the price of silver. And of course that's happening. Gold is going up at the moment, maybe not copper at the moment.
Gold's bull market continues to unfold, driven not by speculation, but by structural forces that have historically defined long-term peaks. The last major top nearly 25 years ago laid the groundwork for where we are today, and the numbers suggest this secular run could carry gold towards $6,000 per ounce. Silver, too, while not mined primarily for its own sake, will ride the momentum, its fortunes often tied to rising copper and gold prices rather than its standalone demand. What's clear is that we are in the middle of a secular bull, not at its beginning, and certainly not at its end. SteveHanke, a respected economist known for his work on currency and monetary policy, emphasizes the critical role of money supply growth in shaping outcomes. Alongside him, market strategist Clive Thompson highlights the patterns of past cycles and the realistic targets investors should prepare for. Their perspectives converge on one essential truth: stability is impossible without recognizing the driving force of money itself. As the Federal Reserve continues to overlook this reality, the risk of policy error grows, weakening the dollar and amplifying gold's long-term case. Disposable income growth, currency debasement, and the erosion of paper market confidence are aligning, setting the stage for a repricing that catches many off guard. Tangible assets, particularly precious metals, provide the stability that monetary authorities have failed to deliver. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Number one, they've gone through some assumptions, and with those assumptions, they've come up with a target price of $5,000 an ounce. Not using those assumptions, but a more standard kind of thinking, and that is what's going on with the growth in U.S. disposable income. I think that this secular bull market in gold that we've been in, David, will maybe end up at $6,000 an ounce, not $5,000. But mine is based on not all these assumptions they've made about Fed independence and what's going on with the bond prices and dollar and all this other stuff. We anticipate the next peak will be in the gold price based on, the last gold price peak was back in 2002, over 25 years, well, almost 25 years ago. So if you look at the gold market that we're in now, and it is in a secular bull, and I've been bullish on it almost since day one. I think a peak in this secular bull will probably come in around 6,000. I think the key thing is we're talking about the gold market, for God's sakes, and where is gold? Is the gold market in a bull market? Yes, it is. Will the bull continue? Yes, it will. Where will it probably end up peaking out at? 6,000. Yeah. My thinking is, look what's happening to the growth in U.S. disposable per capita income, and look what's happened historically to it and how it's related to gold. Go back to the last bull run that ended up peaking out in 2022, and then go forward from that to this bull market. Again, these are back of the envelope kind of calculation, shall we put it that way? But they don't get into all these complexities about what what exogenously might happen, what's going to interfere, the independence of the Fed, a world war, this thing, that thing. If those things happen, then gold would go to $5,000 an ounce. That's the way the Goldman thinking is going. My thinking, which by the way ends up at kind of roughly the same ballpark in terms of a price. Mine's a little bit higher. Mine's based on kind of endogenously income growing on a per capita basis. Given that increase, what's going to happen? So the question is are we in a bull market? Yes. Will the bull market continue? Yes. Is this the start of a bull market? No, it's kind of middle of the bull market. And then the question is, which I usually don't do, by the way, these kind of target prices. As you know, as somebody is trading, all you have to know is the direction of the market, not what some endpoint is going to be. But my general thinking is I'm comfortable with this thing until it gets, up towards $6,000 an ounce. The Fed not recognizing the money supply is like the Pope not recognizing Jesus Christ. So that is the key to the thing. Trump is on this, and I think, I told you I've had a couple of meetings at the White House in the last month, and I did deliver a copy of Sikirke and Hanke's book, Making Money Work. The key front point is start looking at the money supply again. That's what drives the economy. So Trump, I don't know where he got the message. Maybe somebody whispered in his ear or did the tweet, but he got the money supply thing right. Now, exactly how they would implement and so forth gets into the weeds of that's another story. But at least the money supply, somebody is whispered in Trump's ear that the money supply growth is important. So that's a very critical thing, actually. That in that quote, that's the most important part.
What happens to markets when the Fed starts loosening monetary policy, like you said?
Well, what happens to markets and the economy, I think that it's a positive, not a negative, because what they should be doing is targeting the money supply and trying to keep it growing at about 6% per year on a steady basis. And if they did that, the economy would be stabilized. We would hit pretty close to the 2% inflation target, and that would be the end of the story. Everything, we'd get off this roller coaster that we've been on. That's what would happen if they did it right. If they did it right, things would be stable, and stability might not be everything, but everything is nothing without stability. Dollar's going to keep weakening, and get into the key dollar price is the dollar euro rate, and I think the fair value 120 to 140, and we're at about let's just look. It's around 117, 118. I haven't actually looked today. Today, as we speak, 1.175. Just about exactly where I thought it was. So it's still strong. It's on the strong end of things, David. It's stronger than 120, which is my strong end for the fair value range of 120 to 140. So I think that the dollar will slip into the fair value range. It will go from 117 to weaken to 120 and further into that range.
The Fed's quarter-point rate cut has produced a curious outcome. Instead of falling, yields on the 10-year and 30-year treasuries have climbed. Markets are reading the move as inflationary, anticipating further monetary expansion and demanding higher compensation for holding long-term debt. At the same time, recessionary concerns are surfacing. Lower tax revenues mean the government will be forced into heavier borrowing, pushing more supply into the bond market and driving yields higher. Parallel to this, the dollar index has weakened sharply this year, slipping over 11% since January, reflecting investors' rotation out of the currency into other assets. The Swiss franc's long-term strength against the dollar illustrates the erosion of purchasing power over decades. Against this backdrop, gold has surged to record highs, with silver breaking above $43, levels not seen in over a decade. Industrial demand, particularly in electronics and solar, keeps pressure on already tight supplies, and the looming U.S. decision to classify silver as a strategic mineral only reinforces the scarcity narrative. With supply lagging consumption and monetary instability fueling safe haven flows, the setup for precious metals remains firmly intact. Let's get back to the interview.
The US government 10-year bond, and the white line you see here going down, that's Wednesday's FOMC meeting, and it's the moment they announced the cut in rates by 0.25%. Yet, despite cutting the rates, the interest rate on the the interest rate of the 10-year bond has risen from 4.04 to 4.14, up 0.1%. Likewise, on the 30-year bond, the interest rate since the cut here, you see the spike down, that was where this cut happened on Wednesday evening. That's European time on Wednesday evening. You see the interest rates have risen on the 30-year bond. Why are the rates rising? Well, several reasons, but first of all, cutting the short-term rates is seen as inflationary. People are expecting money printing further down the line, so they demand higher interest rates on the long end. Secondly, the cutting of the rates is a confirmation that the economy is slowing, and that means recession, perhaps. And if we have a recession, the tax receipts will be less than the government expected or wanted. Therefore, they'll have to borrow more. And if they borrow more, they're going to be borrowing 10-year bonds, 20-year bonds, because they spread it out across the yield curve. But the more they want to sell of these bonds, the lower the price is going to be, because people buy the first bond at a higher price, but the next bond at a lower price, the next bond at a lower price. So as the prices of bonds go down, the yield goes up, which is what's happened last week. The yield's gone up because people expect the government to be forced into selling more bonds down the line. Now, going to currencies, as you see, the dollar has been falling since the start of the year. That's the start of January, and down, all the year down. Last week it hit, in the middle of the week, it hit the lowest point ever when the day before they announced the interest rate cut. But we started the year at around 109, 110 on the dollar index, DXY. DXY is a basket of international currencies against the dollar. So basically it means the dollar's been going down against that basket. And it's gone down from 100, let's call it 110 for simplicity, to 97.65. It was 1% below that at 196.4 last week. So the dollar at the moment is about 11-12% down on the year, which might explain why all those stock markets and everything else is going up. People are bailing out of the dollar to go into other things. Now, what about gold? Let's just have a quick look at the Swiss franc against the dollars. So the Swiss franc here has been rising all year since the beginning of 2025. And let's see how the Swiss franc's been doing long term against the dollar. Well, we're going back to 1990. 1990, 1 Swiss franc would have bought you 60 cents American. And today, 1 Swiss franc buys you $1.26 American. In other words, the Swiss franc buys you more than twice as many dollars now as it did in 1990. Is that the Swiss franc being strong or the dollar being weak? Well, actually, it means the truth is they're both weak. It's just the dollar has been the weaker of the two. But let's go now to gold and see how that's doing. So this week, on Tuesday, gold hit an all-time record. Let's bring up the long-term chart of gold there. You can see it about there, going up and up and up like a straight line. I'll reduce that to 5 years to make it more readable. There we are, and I'll make it a 1-year chart too. Yeah, as you can see, all-time record. It wasn't quite a record on Friday, but Tuesday was the record, and we're as near as makes no difference to that record. So we're probably going to move higher in the week, I think. Silver also surprised to the upside. Over $43 now, $43.09. So that clearly is a record for many, many years. It's not been like that for maybe 10 or more years. Yeah, we have to go back to, what year was that? We go back to about 2010, I think it is. Yeah, 2011 maybe. Yeah, 2011 was the peak when it was just below $50. Well, it obviously did touch $50 at the time, but you can't see that on a monthly chart. So anyway, silver performing very well. Don't forget the 25th of September is the end of the consultation period on whether silver should be a strategic mineral of the United States. Assuming that consultation comes to an end and there's no objections, I'm guessing that as it will be a strategic mineral, they'll have to start to stockpile it. Last time the government stockpiled it, they had 2.1 billion ounces in their stockpile. That's all gone, been used on building bombs and God knows what else, but it's all gone anyway. Some of it was auctioned off. So 2.1 billion tons is about 2.5 years mined production. So I don't know where they're going to get the silver from this time around. They certainly can't buy it in any hurry because all of the mined silver is spoken for, because the consumption of silver has for 2 or 3 years exceeded the mined supply, and all the forecasts are the consumption of silver will keep rising and the mined supply is not going to keep rising. And why is the consumption rising? Well, it's electronics, of course weapons as well, but most of it's going into electronics and solar panels, that sort of thing, and your iPhone and anything else which uses electricity and needs a perfect circuit will be using silver. So I think the number of electronic devices is not going to go down, and therefore I think the demand for silver will continue to rise. From most of the silver which is actually mined is mined in conjunction with something else like copper or gold, and therefore it's not so much the rising price of silver which caused people to mine more. It would be more a rising price of gold or a rising price of copper would perhaps boost the price of silver. And of course that's happening. Gold is going up at the moment, maybe not copper at the moment. Let's just have a quick look now at some of the big price changes during the week. Just a sort of quick word on crypto. Bitcoin traded at above $115 in the week, and Ethereum at 4,500. Currently, Bitcoin is at 115,667 and Ethereum is at 4,445.
Central banks can adjust interest rates, policymakers can frame outcomes as under control, and headlines may celebrate temporary strength, but the underlying currents reveal something very different. Rising debt loads, weakening currency confidence, and strained commodity supplies point to structural shifts that cannot be managed with short-term fixes. This is why the most prominent and most informed players are positioning early, whether through gold, silver, or other tangible stores of value, while much of the public remains distracted by short-term moves. For long-term investors, the lesson is to focus less on the noise of day-to-day price action and more on the bigger trend of capital moving into hard assets. Cycles of expansion and contraction are unavoidable, but wealth preservation depends on being aligned before the crowd recognizes what is happening. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.